Hi, folks. This is Mike Zlatnik, Big Mike. I'm joined here by Mikhail Misha Pritzker from Tempo Team. Hi, Misha.
Good morning, everybody.
And we're here to talk about beyond the PPM and what a great deal looks like 2025. Why we decided to do this short presentation is because many of you or many investors look at the PPM as the holy grail, it is the offering document. It is a formal document, but it is not the most important consideration for the investment. PPM, we'll talk about its uses, but the most important element is to understand what a great deal looks like, be able to underwrite and review all the factors that are based on the deal economics, upside, downside risks versus what a PPM says. We'll get to that in just a second. So we'll keep it short. I appreciate your time. Wonderful disclaimer. This is for informational educational purposes. No advice of any kind, no solicitation of any kind. If you're interested in any of our funds or syndications, reach out. Request PPM to accredited investors only. Always consult with your attorney and CPA professional for making any investment decisions. So a couple of words about PPM. What is the purpose of the PPM? Well, PPM is a scary document. The purpose of the PPM is to tell you 100 ways how you can lose all your money. That's the risk disclosures. And most people don't really understand what the purpose of the PPM is. It's a formal legal document requirement. It does disclose material facts about the deal, which is important. So PPM has its place, but it is a design, and most of these offering documents look very scary. So it tells you obviously who's running the deal. It tells you about the formal terms of the deals, what are the fees paid to the sponsor or operator, what are the preferred returns, what are the splits. All those things matter, of course, but they're not the most important thing in the deal. They're protection mechanisms for investors. But what is more important is the underwriting process. So PPM, review of PPM is a part of the underwriting process. And the investor must always look beyond the PPM. Get to know, like, and trust the sponsor, of course, who they're investing with. Understand their capacity and ability to execute the business plan of a project. Review the projections or the pro forma. Understand various inputs and other success factors, risks versus rewards. What kind of risk profile they're dealing with, what kind of an upside they have, and assess how a given investment fits their individual investment goals, cash flow needs, risk tolerance, time horizon, and other factors. And let's move forward. Now we will talk about what a great deal looks like so folks can actually understand what we are looking at today. And Misha, would you be so kind to take us through?
Yeah, absolutely, Mike. Thank you so much. So, as you know, last several years were really tough for multifamily market. So now for buyers, it's a very good time to buy not just a good deal, but an exceptional good deal. That's where we look at. Yeah. And briefly, if we talk about it, what do we value today? We value deep buy. This is a part of where the value is created. You buy it cheap. Yeah. And we're talking about cap rate spread of 2%, which
Can
means
you
that
explain what does a cap rate spread mean? Can you explain it?
yeah, of course. The cap rate spread is the spread between the return that the property gives you, cash buy, and the cost of money that you borrow against the property, meaning that you have a positive leverage, meaning that you have cheaper money than the property is delivering, which makes sense. Yeah, that's what people are hunting for. So you find a property that delivers more profit than the cost of money that you borrow against the property. That's what the spread happens to be. And the other part
If you're
of
buying at a
value is
nine cap rate, if you're buying at a nine cap rate, what the cost of money is 7, that's 2% spread. Right?
that's
Most
exactly what it
multifamily
is.
deals, it was a negative spread a few years ago. You would buy at the cap rate of 4, and the cost of money was 5. It was negative 1%. Now it's a positive 2%.
Yeah. Absolutely. Now it's a good deal if we look at it this way. The other part of value creation is that the price is well below the reconstruction cost. So the average square footage of multiple units, if you average it down, would be around 900 square feet. And if you want to rebuild it since the very beginning, it's going to cost you probably $200,000 a unit, including soft costs and hard costs, or even more. Yeah. And if you buy it with a more than 50% discount, that's considered to be a good deal. We want to look at the properties that have strong positive cash flow since day one, meaning they have good occupancy, good renters, low delinquency, and the cash flow is coming and it's sufficient to cover all expenses. We consider good deal if it has big bonus depreciation potential. Of course, it's a subject to 100% bonus renewal by an existing administration. Of course, we value the sponsor capacity and track record because normally the bad things happen on execution side because time is a value, team is a value, experience is a value, and so on. Location. Location is supposed to be exceptionally great, means that the location backups the rental costs, the population growth, jobs, and market per se is active in that location. Of course, today, a lot of properties are looking for having larger incentive. Not all of them do have that. And we're looking at the deals that have utility reimbursement, tax abatements, and so on, because that delivers more value to the property. So maybe now we jump into the existing project that we're working on right now and use it as an example. It's called Beverly on the Lake. So it has a purchase cap rate of more than 9%. The cost is $79K a door, which is more than 50% below the reconstruction cost. It has a potential for massive utility reimbursement on energy, and it has a potential for 2x depreciation-driven losses if 100% of bonus is renewed. So this is the first part that complies with our requirements, and I think that's a great property. I've been there personally. It's located on a big lake. Yeah, it has its own boat sleeps, and the property is in a great shape, I would say. Yeah. So the sponsor is buying it for about 83.7 million and hopes to invest about 25,000 per door, I think, and has an average estimation of selling it for $160 million. Why do we consider that a deep buy? Just check it out the market, for example, for comparables. We'll look at it. Waverly on the Lake, it's around 79K per door, and the existing deals that happen in the market, like 24, a little bit of 23, those are like 125, 121K a door, which leaves a lot of space, especially considering that the market rent is also below the market. At the property you see, it's $1,144 compared to all the others who are well higher than $100,300. So that gives us an idea that this property has a bunch of potential, speaking about the growth potential and speaking about the deep buy. And this is the capital stack. And Mike, I would like to ask you to cover that slide, please, and explain what is the difference between pref equity and the common equity over here.
Sure. So this is an example of a deal that is structured with a preferred and common equity as a component of a total equity stack. So the bank debt is $88.5 million, and it's a floating rate debt, which is a rate cap. Rate cap is basically a policy you could buy to protect the interest rate that you're paying, and it's capped at 7%. So effective interest rate that is paid to the bank is at 7%, and it's bought for multiple years. And that spread between 9% cap rate and 7% cap rate is a positive 2% spread. That enables initial cash flow from day one on this deal. This is the strength of the deal. But the capital stack here is pretty straightforward. There's a preferred equity, which basically receives no depreciation at X, as if it was almost secondary debt. But it doesn't get paid full. It only gets paid a certain amount of cash flow, and then the common equity gets the same amount of cash flow. And then the preferred equity essentially creates additional leverage for the deal. So folks have asked, well, when I'm in a common equity, I'm participating in the tempo raise of $9 million, or sponsor total, we have 13.876 million of common equity. Isn't that a higher risk to be in a common equity versus preferred equity? And the answer is, of course, it is a higher risk on the same deal. So you have a choice being a preferred equity, capping your upside, limiting your tax benefits, versus the common equity. It's a trade-off. You take a greater upside, you take tax benefits, you take upside versus the risk-reward profile. But what's really important to understand is in many deals, in a deep buy like this, being in common equity can often be lower risk than on some other deals where it's not such a good buy. So when you buy in your common equity, you have the biggest upside. Because you bought it so deep, you have downside protection mechanisms. But if you compare preferred versus common on the same deal, risk profile on a common, of course, is higher than the preferred. But it's a trade-off. And the reason we set it up this way, because we see such great upside, and our investors would like to get great tax benefits. And here's an example of a waterfall for common equity. We set it up with a 9 pref and then a split. But overall, it's just a great deal, institutional quality waterfall. And participating in common equity, as much as it might feel to be a little bit more higher risk, but it can be actually a great opportunity because such a deep buy, and the property has massive upside through renovation. And you're not speculating that the property will increase in the value. You buy it already below the market, and then you create forced appreciation through the value at work.
Yeah, thank you, Mike. And let me just get back for a second to the project cash flow. And that particular project is really strong, positive cash flowing project since day one. And as Mike mentioned, because of that spread that allows us to have it, you see the investors are going to be getting 6% on an annual basis paid quarterly since like day one, basically. And the rest of the appreciation will come when the project is planned for exit. You see that's the plan. If you would invest $100,000 today, what would it be by 2030? It's about $200,007. That's a common equity, obviously. Yeah, so equity multiple that is targeted on the deal is 2.37x, which is in industry standard, I would say even higher than that. And getting back for a second to market per se, where the property is, what we do like about Midwest precisely, and Detroit in this case, is that you see that starting, let's say, like 2007, the rental growth is very sustainable. There are no fluctuations like in hot markets, like in Texas or Florida, where it goes ups and downs, ups and downs. Here it's like a steady, eddy growth, and the project is in the 2-star rating here that we're talking about, Waverly, and you see it's been going up and up and up and up because normally it's backed up by jobs and people move there for a reason. Yeah, and the reason should be sustainable. That's what do we like it about. If you look at it from the vacancy perspective, the same market, you see that the vacancy starting 2024 in the beginning, they keep on going down, and projected to go down because people getting back, to where they should be. This is about the sponsor, Mike. Probably you can cover that a little deeper than I would do because you know people like for many, many years. And please tell us more about Pepper Park.
Yeah, in this example, but it's just part of the underwriting. We do a lot of work and invest with Pepper Pike. It's a strong Midwest-focused organization that only does multifamily and only does it in 3 primary markets. Suburbs of Detroit, where this property is one of those markets. And they've done a lot of deals, dozens of deals, about $1.5 billion AUM. And effectively, they have a strong track record of execution on many of these properties. It's just an example of some of the projects completed by the sponsor. So just a quick view, but it's a very short representation of a much bigger track record. So let's continue.
Yeah, and I can add a few words in myself. I know the company for several years as of now, and I've been to multiple projects that they operate right now, and they have their own supply chain from Asia, I would say, India, Vietnam, and so on, delivering them the cabinets, the flooring, and all the materials they need. So supplies are very sustainable. They have their own warehouses in the places where they operate, which gives us, again, additional layer of assurance that the value add procedures are going to be made on time and in accordance with the costs that were projected for that particular part of the deal. Yeah.
Thank you, Nisha. And one important element is to understand all those parts of underwriting. And we just talked about the capacity, track record, and history of the sponsor and the ability to execute on a forward basis, just as an example. So, folks, that's it. We're going to keep it short. We just wanted to show you what a great deal looks like. If you're interested to take a look at this deal or any of the Tempo offerings, please reach out to us by emailing invest@tempofunding.com. Request PPM to accredited investors only. Scan the QR code. We appreciate your time and attention. Until the next time, thank you all.
Thank you so much, everybody.